Module 2, the FICO Score Breakdown, Beginner Level, Lesson 2.1, Payment History, 35%. This lesson takes about 5 minutes to listen to. What you'll learn in this lesson, you'll discover why payment history is the #1 factor, how late payments are categorized, and the autopay strategy that protects your score. The lesson, payment history makes up 35% of your FICO score. It is the single biggest factor. Lenders want to know one thing: will you pay us back? Your track record of paying bills on time or not paying them on time answers that question. How late payments work. Not all late payments are equal. If a payment is 1 to 29 days late, there is no credit impact. It is not reported. At 30 days late, the impact becomes moderate, often around 60 points, and it is reported as 30 days late. At 60 days late, the damage becomes serious, often around 75 points. At 90 days late, the impact is severe, often around 90 points. At 120 days or more, the damage is maximum, and the account may be sent to collections. The Autopay Shield set up autopay for at least the minimum payment on every account. This matters because you'll never accidentally miss a payment, even if cash is tight. The minimum is covered, and it removes stress and guesswork. A smart strategy is to set autopay for the minimum, then make extra payments manually when you can. Timing matters. Payments are due on a specific date. Most accounts have a grace period between 15 and 21 days. A payment is not reported late until it is 30 days past due. However, interest usually starts after the due date. Pay by the due date to avoid interest. Pay before 30 days to avoid credit damage. Key takeaway: one late payment can drop your score between 60 and 110 points. It can take 1 to 2 years of perfect payment history to recover. Prevention is everything. Action step before moving to the next lesson: log into every credit account you have. Enable autopay for at least the minimum payment. Set calendar reminders 3 days before due dates. Lesson 2.2, Credit Utilization, 30%. This lesson takes about 5 minutes to listen to. What you'll learn in this lesson, you'll discover what credit utilization is, how it's calculated, the magic numbers, and ways to lower utilization quickly. The lesson: credit utilization is how much of your available credit you are using. It makes up 30% of your credit score, making it the second biggest factor. The formula: credit utilization equals total balances divided by total credit limits, multiplied by 100. For example, a $10,000 limit with a $3,000 balance equals 30% utilization. The magic number 0% utilization is not ideal because it shows no activity. 1 to 9% earns maximum points. 10 to 29% is good. 30 to 49% is acceptable, but not ideal. 50% and above hurts your score. 75% or more causes major damage. The sweet spot is between 1 and 10%. Per card versus overall utilization. Both matter. Overall utilization is the total of all balances divided by total limits. Per card utilization is each card's balance divided by its individual limit. Even if your overall utilization is low, a maxed-out single card can still hurt you. Quick ways to lower utilization. Pay balances down before the statement closes because the statement balance is what gets reported. Make multiple payments per month instead of waiting for the due date. Request credit limit increases so the same balance represents a smaller percentage. And keep old cards open, even with zero balances, because they add to available credit. Key takeaway: utilization has no memory. A high balance last month does not matter if utilization is low this month. This is the fastest factor to improve. Action step before moving on: calculate your current utilization, both overall and per card. Identify cards above 30%. Create a plan to pay those down first. Lesson 2.3, Length of Credit History, 15%. This lesson takes about 4 minutes to listen to. What you'll learn. In this lesson, you'll discover how credit age is calculated, why you should never close old accounts, and how to borrow credit age instantly. The lesson length of credit history makes up 15% of your FICO score. Lenders like seeing a long, stable track record. How credit age is calculated, three things matter: the age of your oldest account, the age of your newest account, and the average age of all accounts combined. What's considered good? An average age under 2 years is poor. 2 to 4 years is fair. 5 to 7 years is good. 7 years or more is excellent. The biggest mistake: closing old credit cards. When you close your oldest card, your oldest account disappears. Your average age drops. Available credit decreases and utilization often increases. Even if you never use the card, keep the account open. Cut up the card if needed, but leave the account active. The authorized user shortcut. If you can't wait years, becoming an authorized user can help. A family member adds you to an old, well-managed account. Their payment history appears on your report. Their credit age becomes part of yours. The account should be at least 2 years old, have perfect payment history, low utilization, and belong to someone you trust. You don't need the physical card. Key takeaway: time helps credit. Never close old accounts, and use the authorized user strategy wisely when needed. Action step: find your oldest credit account. Make sure it stays open. Consider whether authorized user status could help you. Lesson 2.4. Credit Mix, 10%. This lesson takes about 4 minutes to listen to. What you'll learn in this lesson: you'll discover the two types of credit, why having both matters, and how to improve mix without debt. The lesson: Credit Mix measures the variety of credit accounts you have. It makes up 10% of your FICO score. The two types of credit: revolving credit includes credit cards, store cards, and lines of credit. Balances change and minimum payments vary. Installment credit includes auto loans, mortgages, student loans, and personal loans. Payments are fixed with a set end date. The ideal mix. Having both types shows lenders you can manage different debts. 2 to 3 credit cards and at least one installment account is a strong mix. If you don't have installment credit, you don't need debt, you don't need. A credit builder loan can help. Small loan amounts, money held in savings, reported as an installment loan and returned at payoff. Key takeaway: credit mix is only 10%. Do not take on unnecessary debt. But if you're close to your goal, a credit builder can help. Action step list the credit types you have. If you only have cards, research credit builder loans. Do not open anything new until disputes are complete. Lesson 2.5. New credit and inquiries, 10%. This lesson takes about 4 minutes to listen to. What you'll learn. In this lesson, you'll discover the difference between hard and soft inquiries, how rate shopping works, and when to stop applying. The lesson: new credit measures how often you apply for credit. It makes up 10% of your FICO score. Hard versus soft inquiries. Hard inquiries happen when you apply for credit. They can lower your score 5 to 10 points, stay on your report for 2 years, and impact your score for 12 months. Soft inquiries happen when you check your own credit, receive pre-approval offers, or go through employment checks. They do not affect your score. Rate shopping rules. FICO allows rate shopping for certain loans. Multiple auto, mortgage, or student loan inquiries within 14 to 45 days count as one. This rule does not apply to credit cards. When to stop applying. Stop applying for credit before a mortgage, while disputing items, after 3 inquiries in 6 months, or when your score is already low. Key takeaway: each application can cost 5 to 10 points. If you are repairing credit, pause applications until your score improves. Final action step: check how many hard inquiries you have in the last 12 months. Commit to not applying during your repair journey. Remember the rate shopping rule for major loans. Next up in Module 3, you'll learn how to pull all 3 credit reports for free. Module 2 complete. You now understand payment history, credit utilization, length of history, credit mix, and new credit. Continue to Module 3, getting your reports.